We are talking about this idea of the great wealth transfer today. So, what is it, and how might we prepare for it, knowing what we know? Kicking things off, I will say that this is a brief agenda of some topics that we may be jumping into. We may take a different direction with things, but we want to start off by just defining what is this idea of the great wealth transfer, and then what are some of the concerns that folks are thinking about surrounding this economic event that we have forthcoming over the next 20 years or so. What will happen to the wealth? And what economic outlooks might we be able to start to predict from it? Secondly, how does it compare to past generations? And then, of course, a topic that comes up often is if I'm somebody who will be transferring some of this money, how do I make sure that the inheritors are set up with the right psychology and habits with their money to have success with it, to make sure that we don't make mistakes with it and end up using it in areas in which we did not intend. Give a brief overview of both of our backgrounds. So I'm Marshall Moore. I'm the community development advocate over here at On Tap Credit Union. I do the community development largely through our financial education and coaching program. That's a very foundational financial education and coaching program. So we focus on a couple of things. And one of the main things is, what are the menu of options out there for what a budget even could look like? Of course, we live in this capitalist society that just throws us to the wolves, financially speaking, right? We tend to not get any training, any education through high school or anything like that, although there are more programs that are luckily, thankfully, getting up and developed in that regard. But it's an absolute pleasure to do this free foundational financial education in our community. And so that's kind of the background for me. And Dave, I will let you introduce yourself.
All right, thank you. So Dave Sprague, I've been with OnTap here for about 3 years now. I've been in the industry for probably more years than I should ever admit, but a number of decades. And this topic, I've been working really on both sides of it. I've seen great opportunities and I've seen great opportunities lost when it comes to wealth transfer. Ideally, deal mostly with pre-retirees and retirees, and wealth transfer is a big portion of that conversation. Happy to join you on this. It's going to be, as Marshall and I have talked about before, this is a meaty topic. We may just create more questions than we answer, but we want to make sure that you know that you can reach out to either one of us at any time, and we're more than happy to be a resource for you.
Yes, absolutely. Yeah. And, when we're talking about some of these topics, we are always sticking to the very high level overview because personal finance is personal. And at the end of the day, it's impossible to go into specific details of every situation out there. But having an understanding of the overview of the topic can really help us to begin some of those individual conversations where we can get into a little bit more of the details of somebody's economic and financial situations and really be able to help think about some plans from there. Awesome. I'll do a brief overview of who we are at OnTap Credit Union. Won't go into too many details here. Many of the folks on this call are already members, but I know there's a few folks who are not members yet. They are thinking about opening a free account with us. The background for OnTap Credit Union, first of all, I'll talk about credit unions. Credit unions are a not-for-profit structure. So yes, we do all of the same types of things that a bank might do. You can deposit your funds safely with us. You can borrow funds with us. But the not-for-profit structure of a credit union means that any profits that we make, we are trying to give back to our members. And of course, that happens through high yields on deposits, through low rates on loans. But we also recognize that nobody ever built a wealthy life by saving a 0.5% on an auto loan, right? We build our wealthy lives by engaging in ongoing, healthy, positive, productive conversations about our money. And that's part of why Dave and I are so passionate about having those conversations and being resources within our community. We love these credit union phrases of people helping people. That's what it's all about. And the idea of not for profit, not for charity, but for service. So if you are one of the folks who is not currently a member and you find this information for the next 40 minutes valuable, fantastic. We have great products. We're not going to tell you about those on this call, but consider opening a free account with us. Come over, check us out. If you don't love where you're banking right now, I can almost guarantee that you will like what we have going on over at OnTap Credit Union. Last note there is, of course, we started as Coors Credit Union starting in the 50s, and the OnTap is a hat tip to starting as that big brewery credit union. All right, with that said, let us go ahead and jump into things. So we talked about, and I'm actually going to stop sharing my screen for just a moment so that we can jump into a few more of the topics at hand here. The big one that I wanted to start with is just defining what is this so-called great wealth transfer. It's this economic event that we are just beginning to start to embark upon. And basically, the background behind this is that the studies out there have shown that about $84 trillion in assets is set to change hands over the next 20 years or so. These estimates come from the consulting firm Cerulli Associates. There's a couple of different studies out there, so you may find that the numbers vary slightly, but really that is the economic event that we are thinking about and focusing on. And so how did we get to a place where this economic event is occurring? Well, we can go into a few more of the demographic dynamics, but the short kind of overview of things is that the baby boomer generation is not only the biggest generation in the history of our country, but also they have amassed more wealth than any other generation before us. So, of course, there have been generational transfers of wealth over time, but this one in particular is of note just because of the sheer asset size that is set to be transferred during the next 20 years or so. If you extend it a little bit beyond the next 20-year time frame, it is somewhere in the $100 trillion range. And so the big question that comes up from this is, as we begin this process of this wealth transfer, from both sides of the coin, we want to ask some questions. So if I am a baby boomer that has amassed wealth during my life, I want to make sure that I'm set up to appropriately transfer that wealth to the places or the people who I care about. And, at the end of the day, there's really three things that could be done with our money, right? It can go to the government, it can go to people, our families or whoever we designate, or it can go to charity. And so really being intentional with about how we set up that process becomes very important. And that's where we want to provide a little bit of context and numbers here. One more thing that I'll mention before I show a brief bit of numbers and then we jump into a few of the actual dynamics that emerge from this are that there is a trend where there was a Bank of America private bank study in 2022 that was a study of wealthy Americans that basically said generationally, we have a trend emerging where millennials and Gen Z, which are the two generations that are set to inherit a lot of this wealth, they have slightly different economic perspectives than the baby boomers might have, right? And we can see that on a very simplistic level by seeing, sometimes some of these younger generations are interested in things like cryptocurrency, let's say, an alternative investment that is not something that we would traditionally think of. And so that can bring up some concerns about how will this wealth be managed and are we prepared? Are we passing down the appropriate lessons in this regard? And so that'll be a topic that we get into a little bit more. Now, before we jump into some of the details there, I did just want to show this chart that showed a little bit more of, let me put this in full screen view here, that showed a little bit more of the estimated wealth to be inherited through 2045. So again, looking at the next 20 years by generation. And we see that in terms of the breakdown of generations, we have Gen X millennials, and Gen Z that are in the mix here. And the reason that we bring this up is simply because each of our generations, we have a slightly different perspective. Economically, we have different ways of communicating. And so all of that comes into the conversation as we begin to figure out what does it look like to pass on some of this wealth, whether through inheritance, how we go about doing estate planning, and some of those pieces. So I'll stop sharing again, and at this point, open up the conversation to Dave slightly to jump in here. There's a few more generational trends that we can talk about, but Dave, just I'm curious to hear your perspective on the broader great wealth transfer that we're about to go into. Where would you start
Yeah.
with us?
So that's a great question, and sometimes it's easier asked than answered. So
Yeah.
if I get going off on a tangent, let me know. I think a big part of this wealth transfer, and this sounds interesting because remember, I've been able to work with both the folks that are giving the money and the folks that are receiving the money. One of them is fascinating because I do believe to a large extent that the baby boomer generation is, or the previous generations as well, in a way, they're dying with too much money. Yeah, I know that sounds a little bit odd right off the bat, but the way their plans have been set up, you have a lot of folks that didn't spend the money, not because they couldn't use it or didn't want to spend it, but they didn't have any faith in what was going to happen in their investments in the next 10, 20, 30 years during retirement. So therefore, what they ended up doing was nothing. And I mean, that's life unlived in my opinion. So there's when you look at financial planning and retirement planning, one of the biggest risks is behavioral risk. And behavioral risk can mean a number of different things. It can mean making bad decisions with your investments, but it also can make it, to me, and this resonates more with my clients than anything else, the behavioral risk is that they don't understand where their money's coming from. They don't understand how it's set up. They don't have a plan in place. My dad used to always tell me, Dave, I don't care what you do, just do it on purpose. Not a lot of people are doing things on purpose. So they're leaving a lot of life unlived. And really what that is if you're dying with a ton of money, or to make it nicer, you reach end of retirement with a lot of money, then you're giving up an opportunity to live. So on that side, I think there's a lot of conversations to be had. I'm not saying don't leave money for folks, but you need to be able to have enough confidence in your plan that empowers you to go out and do that family reunion or get that extra round of golf or take that extra trip, whatever it may be. Now, on the flip side, on the receiving side, the folks that are getting this money, they're going to largely they'll get a chunk, and it's going to hit them at a very interesting time in their life and stressful time in their life because obviously they've just lost somebody they were close to and they loved, and they have to start making some quick decisions. You have to be really, really careful with that. Now, we as the people that are passing wealth along can help them with that, with where your assets are. So there's a saying in this sector that it's not necessarily about asset allocation, it's about asset location. So for example, you have basically three types of money. You have pre-tax money. That's what we call always taxable. That's your 401ks, your IRAs, those kind of things. They're traditional IRAs. Then you have sometimes taxable money, and that's in the brokerage accounts. And the reason why we call that sometimes taxable is you may have municipal bonds, for example, in there, and those aren't taxed necessarily. And then you have never taxable, and that's kind of the Roth IRAs that are becoming very, very popular. It's really important when you start spending your assets down, if you've earmarked it for legacy, to have the proper accounts earmarked to be passed along because you can have significant impacts on the tax consequences. And keep in mind, I know this, you mentioned it early, Marshall, which is so true. We're talking generalities here. Everybody has a unique set of circumstances, a unique set of goals. So please don't take this as direct advice. But you want your folks to maximize their income from their inheritance. And remember, they're probably receiving this inheritance when they're at a point in their life where they're maximizing their income. So they may, in a lot of situations, may be at a very high tax bracket. And if they inherit assets that need to be liquidated quickly or over a certain number of years, you could be handing off a ticking time bomb from a tax perspective. So, a couple of things to keep in mind. If you are one of the folks that are looking at leaving this legacy, first off, make sure your registrations are correct, make sure your designated beneficiaries are correct, and make sure you have a plan for handing that money off. I've always been a big fan of being pretty specific with what we do with our money. And I always ask the clients and members to assign a certain chunk of money a job. Lots of time that job is to grow. Sometimes it's to generate income. Sometimes it's to pass on and provide a legacy. Each one of those jobs requires a very different set of rules. And you just, if you just have one big bucket of money that you've been taking some income from, you've been asking to grow, and you're passing it on, that's hugely inefficient and could cost you a ton down the road. And like I said, I could go off on so many different tangents, but I don't want to
Yeah.
get us away from what we're looking at here.
Well, this is fantastic because I have some questions here in terms of, so I've been taking notes and I love this idea of whatever you do it on purpose. And that does take some time allocated towards thinking through what is it that I want to do on purpose, and sometimes a bit of that learning that can occur. So it's always super useful to create our strategies and our systems that allow us to do that incremental learning over time. It can be overwhelming to try to take in everything at once, but getting to a place where we create a habit where we can continue to educate ourselves in some of these small ways. Maybe it's a Friday at noon and I log into a webinar with my local folks at On Tap who are discussing this. And then I book a meeting later on and can do that incremental learning over time. But from what I heard, I wanted to dive into a few of the specifics because you had a couple of big points here that I think are worth bringing up. So the first one is, how do we make sure that we are getting the most out of life ourselves? Like, and the point that I wanted to bring up here is for me, of course, I'm the person who does more of the foundational financial education. And so one of the concepts that comes up is this idea of money dials. So one of the concepts, even before money dials, is called money lenses, which is basically how do we actually think about spending our money? Well, a money lens that is used most commonly in America is cost. How much does that cost? But we all know that there are other ways of assessing how we're spending our money. We could think about value rather than cost, right? Warren Buffett, the great investor, says cost is what you pay, value is what you get. So it's a very different way of thinking about things, but we could also see things through the lens of speed. Sometimes I'm willing to pay more to get something done quickly. I'm willing to pay more to not have to learn it or do it myself. Well, when it comes to money dials, it's a very similar concept, but it's just a slight different take. And what it is the fact that different things can really light me up and make me enjoy spending my money. So, some money dials for some people might be travel, seeing the world. Somebody else, it might be luxury, that they want to go to the fanciest hotel when they go on vacation and just be catered to and have that experience, versus another person might be really into experience. They don't care about the luxury side of things, but they want to go to the national park. It doesn't cost a whole lot, but it is the experience of being there that lights them up. Well, one of the big money dials that comes up for a lot of us is generosity and being able to give back to the people in our lives. And that can look a lot of different ways. And so it could look like being able to pass on an inheritance that can really support my kids for the rest of my life. But some of that we want to consider is also, how could I use this money now to be able to have a family gathering that, you know what, I'm not even worried about what I'm spending. I'm paying for my family to get together, or whatever the case is. But that's a really challenging thing because if we are entering our retirement years, then the thing that comes up, and you alluded to this, Dave, is how do I manage basically things like distributions? How do I make sure that I'm not taking out too much in that account, given my plans for how much I would like to leave to my family or to charity or whatever the case is? So, can you talk briefly just about this idea of distributions? What is generally something that we can think about for like how do I plan for a withdrawal rate when I'm in retirement and deal with some of those components of things in a way that I can balance living for the now and also planning for those things I want to do for my future?
Yeah. So great question. Once again, a lot to unpack there, but
Totally.
a let me start with kind of the scientific answer. There was an MIT professor that decided to get into this business a number of years ago. And before he did, he said, I want to figure out what is in air quotes, a safe withdrawal rate. What he means by that is what percentage can I pull from my retirement savings to supplement my income and guarantee that I won't run out of money. Okay. So what he did is he assumed a 65-year-old couple with a 30-year retirement. And the calculation he did has nothing to do with your wealth. So whether you have multiple millions or you have a few hundred thousand, the percentage is going to be the same. And his calculation, long story short, his calculation came up to 4%. And lots of times you'll hear it called the 4% rule. I hesitate to call it the rule because it's a guideline. And so what he did is he also used something called Monte Carlo testing on this. If you just look at the history of the stock market returns, you really only have one set of data because we can't put 2024 in front of 2020. It just because that didn't happen in history. But Monte Carlo, what they'll do is they'll do 10,000 what if scenarios. And that's what he did. He crunched all the numbers and he figured the withdrawal rate, the safe withdrawal rate was 4%. I mentioned that in case anybody's listening that would like to just do back of a envelope kind of calculation to see how close you are and see what realistically. But with my folks, what I do is I put everybody through what we call the needs, wants, and wishes exercise. And the needs are the things that keep you alive and healthy. That's, keep a roof over your head. You have to stay fed. You have to have transportation. You have to have medical coverage, those kind of things. And it's not a hard concept. A lot of people will over analyze this, but I just tell them go back through, 3 or 6 months of your check register and have three different lines on a yellow pad. And in the needs column, just write down everything that's in there, utilities and so on and so forth. The next column over goes things like golfing or fishing or traveling. Those kind of things go into the needs or the wants category. That's the stuff that makes retirement fun for you. That's the kind of stuff that puts a smile on your face. Too many people in my industry try to define that column for the client or for the member. And to your point, Marshall, we can't do that because I've had some folks in here that have a very, very simple but very fulfilling life. And then I've had other people that are traveling internationally every other month, but they're not real happy with it. It's an amazing dynamic. And then the wishes. Go ahead.
No, no, I'm curious to hear the wishes, and then I'll ask
Okay.
my question.
So the wishes is where we get more aspirational. And so in my practice, what we try to do is cover the needs and the wants. If they have enough resources, we try to cover that with guaranteed streams of income. And that's typically pensions, Social Security. Sometimes we'll include income annuities, things like that. And we end up with two buckets. We end up with an income bucket, and that income bucket is going to spit out your needs and wants every month, regardless of who's in the White House, what's happening in interest rates, what's going on in the world. That's continuing your paycheck. The growth bucket now is what we would use for the growth of your portfolio or the wishes. Uh, so, for example, let's say somebody I've talked to one guy. He's single. He's living just fine on his own, But what he's decided to do is when he dies, he wants to fund a cat sanctuary. And more power to him. If you can do it, do it. So we go through that process, and what ends up happening is in the wishes categories when we start talking about legacy. It's when we start talking about where do you want this money to go, and I'm sure you've heard it just as much as I have. So many people say, you know what, if I do this right, I'm going to die the day before the check bounces. And that's and I get it. I get where they're coming from. What they're really saying is they don't want to pay Uncle Sam anything more than they want. But if you can live the lifestyle that you want and you can leave a lasting legacy, whether it be for your kids, the church, the Dumb Friends League, whatever it may be, I think that's better. And most of the time, folks believe that as well. So, what we do when we build a financial plan is we first off, we take care of that income bucket because we know that's what empowers the clients to live their life and to enjoy their life and maximize things because they don't have to worry about market fluctuations. Then we look at that growth bucket and we say now that the job for that money is very different than your income money. And what's fascinating about it, when you start talking about efficiencies in your plan, you end up with more money in your growth bucket at the end because you've been able to take steps and become more efficient. There are really, really efficient growth vehicles and there are really, really efficient income vehicles. But too often our folks are asking them one chunk of money to do the same thing. And that's a little bit like asking a plow horse to race the Kentucky Derby. It'll finish, but it isn't going to be pretty. And I apologize.
Awesome.
It looks like I've lost my camera here for some reason.
Yeah, no worries. I was able to hear all of that. Hopefully, everybody else was able to hear it as well. Okay, that is really excellent. So the thing you were speaking to last, I want to just bring that back up. I know you had mentioned asset allocation versus asset location. You're also bringing in this idea of income generating assets, fixed assets, things like that. Awesome. Those are all kind of specifics. So that's certainly the type of thing that folks can come and talk to you about and get more specific information on. I wanted to briefly hit on this idea of what should I actually be doing if I am doing estate planning. And I just want to make this pretty short because, there are some other pieces that I do want to get to, but just from an estate planning perspective, I think there are some general rules that I want to throw out there and get your thoughts on and see if they agree with kind of how you think about things. So, in terms of estate planning, I think that the big data that I wanted to bring up here is that the research out there has found that many are not prepared for this shifting of wealth and its effects because more than a third of Americans say they don't plan on discussing the transfer of wealth with their families, despite the fact that a much higher proportion of that plans to leave an inheritance of some sort. And so there is a problem here where we just don't communicate. We don't talk about these things, and there's good reasons for that. These topics can be very heavy. But if people are just if we're just kind of outlining some of the basics for what it looks like to at least engage in these conversations and make sure that we're doing the basic estate planning that we should be doing, then really when we think about an estate plan, from my understanding on kind of a foundational level, really that consists of four main documents, right? There's a will, there's a living will, there is a healthcare power of attorney and a financial power of attorney would be sort of the four main documents involved in that. And those deal with what happens not only after we pass away, but also if we were to not be able to make our own decisions surrounding healthcare or finances while we are still alive as well. Those are kind of the four main documents that we should really be revisiting every couple of years to make sure that they are in order. And also, even before if I'm somebody who is set to inherit wealth, I should really be setting those up even before I inherit any of that wealth, because of the fact that things can happen quickly. We have stories where folks inherited something and a problem went on soon after that inheritance, and they didn't have some of these pieces set up. So am I correct in kind of the overview of what does that estate planning process look like? And do you have more to add for folks on that front?
Yes, so you're hitting on some that's very, very important, and there's a few scenarios that I can give you as that highlights this. Beyond the four that you mentioned, I'll go even one step simpler, if you will. Make sure that you have done a complete and thorough beneficiary review. At least I would, what's the old, they used to tell us around Christmas time, change your batteries in your smoke alarms, right? So you want to do something similar here, especially if you've had some life events. So you want to make sure the beneficiary is correct on your account documents and in your investments. Interesting, a lot of folks don't understand this, but your beneficiary designations trump your trust and your will. So, for example, if you have a brokerage account and you have your child as a beneficiary on the brokerage account, but you have your wife inheriting everything else in your will, well, the brokerage account will go to your child because the beneficiary outweighs everything else, and that's very, very important. The other thing to keep in mind is if you are going through the estate planning process, now you don't have to spend a ton of money, uh, right? And it can become more complicated, but trusts right now aren't as popular as they used to be because the estate tax doesn't kick in until about between 13, 14 million. I think it's 13.6 million per per person in a couple. So you could have close to $28 million before you have an estate tax issue. That could change drastically in the next couple of years, down to 5 or 6 million. And now it's a whole different ball game because between owning your home and your retirement accounts and everything else, you could get close to that number pretty quickly. But make sure when you do that, back to the beneficiary designations, we typically don't want to see, and once again, there's exceptions to this, but generally speaking, you don't want a trust to be the beneficiary of your tax advantaged accounts. So your 401ks, IRAs, things like that. The reason being is that if it's not set up just spot on, all of a sudden you're in a 40% tax bracket when that money is passed on. So it is really important to do that. It's also really important to work with somebody that is well versed in that. Lots of folks will just go out and grab an attorney to have them write up these documents, and I wouldn't recommend that. Make sure when you're doing your due diligence, work with somebody that specializes in that. Make sure it's part of their practice, a big part of their practice, because to what you were alluding to earlier, that that one simple mistake can cause not only financial harm, but we've also seen if it's not written well, it puts the folks inheriting the assets in an awkward situation, and all of a sudden you have siblings fighting against each other. Or we often see, say, well, I don't need all that. I'm just going to put my eldest son as a joint owner on my accounts. Well, now you've put that person in an awkward position because they hold the purse strings, and it can really turn into something that the last thing you want to do is create an issue for your kids.
Absolutely. Yes. And I mean that's a huge component right there, is you want to have everything set up correctly in order to facilitate the family dynamics that we hope to have. We want everybody to be able to get along together, to continue loving each other. We don't want to create
That's right.
squabbles over, inheritance money or things like that, simply by not, setting things up properly. So that is a huge point right there. Okay, with that said, that leads me into a few more questions, just since we were talking about it, about generationally, some of the perspectives that we have. So again, I didn't mention this fully earlier, but the two main factors that make this impending wealth transfer unusually large are number one, demographics. Baby boomers were the second largest generation in US history. They were eclipsed only by the millennials, who have not actually gone through that same wealth transfer generational process quite yet. And in 2022, let me just look at some data here. There were 69 million baby boomers alive in 2022, compared with 70 million Gen Xers and 72 million millennials. So the other factor was economic growth. And so this is where I wanted to ask a few more questions just generationally, because basically the US enjoyed a mostly stable economic growth during the boomers' prime earning years. And that was combined with accessible higher education and home ownership. And that really effectively allowed the baby boomer generation to amass quite a bit of wealth. The thing that I did want to just do a brief comparison with, because as we begin to talk a bit about the generational perspectives on economics, there are some pieces that come up. And so, just to give an example overview of some of the ways that we can kind of disagree with each other sometimes, is there are some of these perspectives that, like, oh man, these younger generations are really frivolous. That's why we're not able, the younger generations are not able as effectively to buy homes, for example. And sometimes that gets a bit misperceived, that the younger generations are spending their money quite frivolously. There's a lot of data in this regard, but I did just want to show some of the comparisons from a previous time, just to set the stage for how economically things have shifted. So let me just briefly share my screen again. I show this chart somewhat regularly, but basically this is what I call the generational wealth gap. So if we go back to 1980, and we compare the starting salary, I'm going to skip this first line and compare the starting salary with a bachelor's degree to 2022. Well, we can see that if we adjust for inflation, the first number with a star behind it, the starting salary of the bachelor's degree was $53,000 at that time. We are now at 54K in 2022. If we inflation adjust the median family income from 1980, we're basically at the same level again, 74K median income. And yet some of the, as I call them, big rocks in our financial jars have drastically changed economically. The cost of tuition, fees, room and board has over doubled once we inflation adjust. And that's not even including the intermediary layer of student loan debt. We also can look at median home prices or rents and see that they have almost doubled in that time as well economically. And this chart doesn't even include the third big rock in our financial jars, which is childcare. And so the point to be made here is simply that the economic times have shifted. And from the work that I do, what I see is that, my goodness, most people end up learning personal finance through making mistakes and correcting them over time. And when we look at these numbers, I think, to me, it becomes more clear that the margin for error in terms of making some of those mistakes is simply thinner than it has ever been. And so I feel like a lot of people are recognizing that now, and we recognize the need to engage in really high quality financial education on a foundational level to figure out, like, how do we deal with the current economic realities that we exist in. We know that homes are harder to buy, some of those pieces, right? And so I'm going to stop sharing now, just because I wanted to give that little bit of background. I guess I'm curious to hear your thoughts on some of the economic differences, and of course I have some ideas as well in terms of how do we effectively make sure that we are passing on not only an inheritance or something like that, but also that we know that if we're doing that, if that lights us up in terms of generosity of providing, some of those pieces for our family moving forward in the future, how do we make sure that those funds are going to be managed appropriately? And do you have any thoughts kind of beginning that side of the conversation?
So you're spot on. We teach our kids everything except for financial health. We teach them how to tie their shoe. We teach them how to throw a baseball. We teach them how to love one another. We go into great lengths, but as soon as you bring up finances, it's an interesting dynamic. One of the so I think education is very important. I think the conversation is very important. I whenever I'm working, especially with older couples, I invite them to bring in their family, not to open up everything and show them what their parents have as far as money, but to talk about it philosophically, because we want everybody to be on the same page, and we want the kids to know what the parents are intending. And sometimes you and I and other folks as professionals in this are in a position where we can broker that conversation more comfortably than the family can. It's just not something that's going to pop up over the kitchen table, unfortunately. Another kind of neat way that I've seen this work is if you are the parent or the grandparent and you do have some money that you want to pass on via the legacy process, do some of it now before you pass away. And I would start looking at gifting. As a matter of fact, I'm a big fan of that. There's a book out there. I think it's called Die with Zero or something. I
Yeah,
forget the details of it.
that's it. Yep.
You know, it's I agree with a lot of the book. I disagree with some of the book, but the reality of it is what they're saying is, once again, don't reach the end of your retirement with a bunch of money and some life unfulfilled. So what I've seen more and more is people will do some gifting while they're alive. And first off, it's fun to do that for them because they can see the impact that it gives the kids or the grandkids or whoever, whether maybe they're helping out with college, whatever it is. So they're still alive and they get to see the smile in these folks' face. But it also opens up good opportunity to have a conversation about fiscal awareness and
Yes.
what the money's for and how to prioritize it. And it's really fulfilling to see the younger folks. Now, once again, we're painting with a broad brush. I had a 19-year-old in here the other day that was probably more mature than me. Just, they're out there, but generationally you're spot on because there's a reason why the statistics prove it out the way it is. But I think the gifting process and the conversation is important. It's also very important for them to, if you are working with a financial advisor, you want that financial advisor to be part of the mix in the family dynamic so they know who to come to when something happens. Hopefully there's already a POA in place, for example, if something happens, and then we can help continue the legacy that the mother or father or grandfather was looking to pass on. One thing to keep in mind on the gifting, this is something that's really uh, very often confused, is I think the number now, I think this year you could gift up to $17,000
I think it might be
without,
18 this year.
could be 18. It changes every year,
Yes, every year.
but that doesn't mean you can't do more. So the only thing that triggers at that number is that you do have to add one more piece of paper to your tax return because Uncle Sam's not going to say if so. Let's say you did 20,000 or 25,000. Nobody has to pay taxes on that. It's not there's not going to be any gift taxes, but Uncle Sam wants to track that against that 13 or 14 million dollar estate number. So if Marshall Moore is getting a $25,000 gift this year, well, Uncle Sam wants a way to track that to make sure that that gift from that individual doesn't go over $14 million or whatever the estate gift level is at that time.
Yes. Yeah.
So it's a lot more flexible than you see. Some folks maybe just want to cut a check for 1 year's tuition, but they're worried about doing that because it could turn into a taxable event. That's not the case at all.
Awesome. Well, that did remind me that you had a very interesting point about the estate limit for the taxable event there being, currently 13.4 million or wherever exactly it is now, but that limit could change in the future. And especially with inflation, with the way that economics works, there could be a time in the future at which it's very easy to reach that limit. And so we should be thinking about some of those pieces choices. The beauty of the idea of gifting now, before, getting to the point of an inheritance is, as you mentioned, it could also be very useful as part of the teaching process, right? And you can kind of be helping to facilitate some of those perspectives as you go, which is a really cool idea. Couple of things on that front that it kind of makes me think about. Um, I don't know where I want to take this, which in particular section. I guess I will just start off by saying, from my perspective as the more the foundational financial educator side of things, I will just mention or throw out there this idea that, my goodness, like myself, even I am not somebody who, even though I love teaching this stuff and I love getting to nerd out about the dynamics of some of these things, I myself am somebody who recognizes that we cannot start with just the numbers or the technical side of things, especially being a millennial myself. I recognize that, hey, I actually don't want to be spending all of my time and energy tracking every expense, or, being really restrictive with my grocery spending or whatever it is. In fact, I actually want to optimize for a simple system that can optimize for a minimum time input while making sure that I'm maximizing the output within that. So I don't want the maximum amount of returns necessarily. I want to minimize the amount of time that I spend while making sure that I'm doing the things that will change my life. So a common topic that I say here is, I think more people, especially of my generation, we spend so much financial advice out there is all about that restriction and tracking every expense. Well, I think we end up spending more time thinking about the $5 questions when we go to the grocery store of, should I restrict myself and not buy berries on this grocery shopping trip, than we do thinking about the big questions like, do I know what my savings rate is? And have I committed to increase that by 0.5% next year or by 1% next year? And that's a life-changing question, right? If I can know what my savings rate is and automate that into automate that monthly contribution into my retirement accounts, my brokerage accounts, whatever it is, that will change the trajectory of my life as opposed to focusing on some of those smaller expenses. So from that perspective, I like to recommend a lot of different tools. We can, jump into some of those pieces. But the last piece that I'll say there that I always like to bring up is, within that, you spoke to this earlier, is if we do that planning of, basically say, hey, what is my safe withdrawal rate that I'm going to assume for my future planning? And then how do I automate the contributions to my savings and investments to get there? Then that actually allows us to know every single month, how much money do I have left over? That is my wants section of the 50-30-20 rule that I like to teach. I actually changed the term wants into my monthly guilt-free spending number, because I think too many of us feel guilty when we spend on
Yep.
ourselves, on our families, on all of those pieces. And so that's one of those areas where I just mentioned this because I love to recommend that to folks. As you mentioned, we parents aren't always the best teachers for our kids, right? Our
Yeah.
kids might roll our eyes at us, or whatever the case is, but getting involved in some of the conversations with folks like you and I, especially when we are making the point that both of us are making very clearly, that it's like, my goodness, we do want to live for the future, of course, but also for the now, because
Yes.
that's what it is about. If we ask the question, what is money for? Many people end up saying something around the answer of, well, money is for me to buy my freedom to do the things I love to do with the people I love to do them with.
Yep.
And so I think that those conversations between folks like you and I can really help to bring out a little bit more of that perspective. And it's not always like, you just got to be more restrictive and put more time in. There are some really simple systems and ways that we can set ourselves up with being able to live both for the future and for today.
Yeah. So one quick thought on that, and I forget who I heard this from, but it was subtly brilliant. don't think about savings as just savings. Think about it as future spending, because what you're taking care of your future self. So it's just delayed spending. You'll get to spend it, and you'll have to spend it. You want to spend it, but just you're not spending it today. And to back that up with automated processes, it's very what what to do is easy. Doing it can be challenging. And it's the same way whether you're learning to cycle or you're trying to go on a diet, whatever it may be, you know what to do. What you need to do is systematize it in such a way that it's easy to do it and it becomes pain free. A lot of the folks that I chat with, one of the good things that's changed recently is changes to the 401k systems. Used to be you had to opt in. Now you're opted in automatically, which I think is going to pay big dividends down the road.
Yeah, this is coming from some of the research of Richard Thaler, who wrote the book Nudge, who says, why, we have shifted the responsibility from a societal responsibility, right? We don't see defined benefit plans very often anymore, like a pension, where the company is responsible for the management of those funds, such that that employee has to be paid the defined benefit is, whether that's a percentage of salary. Well, now we as individuals are responsible for that fund management through contribution plan, where the
Yep.
company says, hey, we will if even give you a match, we will give you X percentage of the match, but then the individual is responsible for the management of those funds, and that can be a bit tricky from there. So yeah, go
Right.
on with this.
Well, so then there's good news and bad news, because you also have target date funds that have come around, and lifestyle funds they call them sometimes, which automatically evolves as you go through life, which isn't hugely efficient, but it's much better than not having any plan at all. Because if you just did it with an individual, lots of times they'll go into a stable value or a money market fund because they don't know what else to go to. So these target date funds are great. One other thing that just you jogged my memory on it, with our audience and a lot of the audiences out there, the people that are passing on wealth now, a lot of them are coming from the pension world,
Yes.
and they never really had to learn because these pensions were fantastic. Unfortunately, they've gone away for a number of different reasons. But if the folks passing on the wealth grew up and were taken care of via a pension, they may not have the wherewithal to explain what to do to the next generation. And then that's where folks like you and I can help. We're happy to chat with anybody on this topic. But if the folks, it's like having somebody trying to explain how to tear apart a motorcycle engine that's never done it. It's just impossible. So reach out to the experts and make sure you lever those experts. And we're certainly ONTAP is I think one of the community leaders in that space, because we are about just being wise, wealthy wise, and making good
Yeah.
decisions. And I think it's very, very important.
One more question for you on the front that I started getting at this. We both started getting at this, but I think some of the concerns with gifting now, like yes, you are able to help with some of the pieces that allow the proper financial habits and psychology to be passed on. But one of the pieces that comes up in the money psychology side of things is, there's this quote, something to the effect of wealth not earned is not as carefully managed as wealth
Right.
that's earned, and things like
Yeah.
that. And so obviously we think that we can play a vital role in helping that that ownership of the management of these funds through being able to work with people like us, and to have some of those conversations that are not just about the numbers, that are really about how we feel about our money too, and give us a reason to go about it. But do you have any thoughts just on that, to kind of close us out on that wealth inherited or not earned versus earned, and kind of other ideas beyond, hey, book a meeting with us and let's chat through it further?
Yeah, so that's a tough one, because it once again it depends on the individual, right? So there's a
Mhm.
lot of folks that are super mature, going to handle it. They respect the people they're getting the money from. They respect how hard those folks work to build that wealth, and that's great. Then you have folks on the other end of the spectrum that, like say, it's going to hit. And I would like to tell you that when I was 18 years old, if I would have come into a bunch of money, it would have been wisely invested, but it probably would have been a big red pickup truck and something else, right? It just wouldn't have happened. So I think it is important to have that conversation early and often. You want to make sure you're positioning folks in the right mindset. I'm not a huge fan of trying to control from the grave,
Yeah.
but if you have somebody you're worried about, and maybe they have a substance abuse problem, maybe they're a spendthrift risk, whatever it may be, that's when you start looking into trusts. And what
Mhm.
you can do from that standpoint is you can within some parameters saying, I want this chunk of money to hit for a specific reason. Maybe it's college, and then another
Yeah.
chunk to come up once they've hit these milestones. So if it's not something you can teach, it might be something you can force. And I'm not a huge fan of it, but there are different levers that you can pull through how you structure your
Yeah.
legacy.
Fantastic. Dave, this is clearly going to drive just a lot more conversations about
That's
specifics. I have my own specific questions that I need to come and meet with you more regularly about as well. For now, we will send out a follow-up that has your information so people can get in touch, book a meeting. Same thing for me. I'll actually also include my spreadsheet resource that is just a free resource for our members that if they can use it, it actually on the last page of the spreadsheet, I am starting to collect a whole bunch of videos that give some further insights into how to use it, as well as some of the specific topics that people may be wondering about, whether it's debt payoff or for you, I should add some of these more longer term estate planning pieces into it. So we'll share those resources. People can go ahead and book a meeting to follow up with us. Should people, right now, should they go and connect with you on LinkedIn?
Yeah, please do, or reach out here directly. We're happy to chat. And like I say, we want to be more of a resource. If you do business with us, fantastic. But we're all about the community. We know how important this can be. One other parting thought: if we do this well, this wealth transfer will continue for more generations. That's one of the things I look at when I see the tons of money that's coming through. If it's handled correctly, you could set up a family for a number of generations if you do it the right way.
Fantastic. To pass on not only generational wealth, but also generational habits and practices that manage those funds well.
Wisdom.
Thank
Yep.
you so much, Dave. Thank you to all
Thank
who
you.
are on. We will follow up with more info and look forward to having some individual conversations with all of you.
Bye bye now.